There's a quote from the Indianapolis 500 that perfectly captures everything that we're going to cover today. One of the winners was once asked what it takes to actually succeed in racing, and his answer was unbelievably simple. To finish first, you must first finish. And that's not just a racing principle, that is also a life principle, and it is definitely a business and investing principle. In investing, the only unforgivable sin is complete and utter ruin, losing all of your money. You don't need to be the smartest person in the room. You don't need to capture every single bit of upside in every investment, and you don't even need to be right all the time. But you cannot afford a single mistake that permanently impairs your capital, where you lose money. Warren Buffett said it best. Rule number one, never lose money. Rule number two, don't forget rule number one. And that's not just a clever line. That is the foundation of compounding. Real estate works extraordinarily well over very long periods of time, but only if you stay in the game long enough to actually allow time to do the work. Most businesses and investors, they don't fail because they lacked intelligence or they lacked ambition. They fail because at some point somewhere along the journey, one weak link just failed. It snapped. Liquidity dried up. Leverage terms came due. Capital markets closed, or an unforeseen shock hit the market, right? A black swan event, and they had no margin for error. So today, we're talking about the principle that makes compounding possible, which is P, protect the downside. I'm Brian Spear, and this is The Sage Investor. Our mission is to help as many people as possible generate cash flow and build legacy wealth in a tax-efficient manner, because that's what I'm trying to do for my family, and we're going to help as many people as possible do that as we can along the way. Right now, you're catching us midstream on a 7-part series where we're walking through each individual letter of the acronym CAPITAL, which is a portion of our Sunrise C.A.P.I.T.A.L strategy where we're digging really, really deep into the foundational principles that help our organization manage capital to the greatest effect possible. We're taking history's greatest entrepreneurs, businessmen, investors. We're taking all their golden nuggets and wisdom, and we've wrapped it up into the Sunrise C.A.P.I.T.A.L strategy to generate cash flow and build legacy wealth in a tax-efficient manner. And today, we're covering part 3, which is P, protect the downside. Protecting the downside means designing your business and your investments so that no single individual event can destroy you. You have no single point of failure. It means survival comes first, always, because the math is unforgiving. If you lose 50% of your capital, you don't need a 50% gain to recover. You need a 100% gain just to get back to even. If you have any single number, right, regardless of how well you've been investing historically, that number continues to get bigger and bigger and bigger. Any number, no matter how impressive, if you multiply it by 0, is 0. So compounding only really works if you avoid that single 0 event. And that's why protecting the downside is not conservative thinking, it's actually strategic thinking. Because the investor who survives will always outlast the speculator who chases the upside and eventually mistimes the market and perishes along the way. Warren Buffett is quoted as saying, the 3 most important words of investing are margin of safety. And we couldn't agree more. And that's really what we mean over at Sunrise when we talk about protecting the downside risk. It means when we go into an investment, we want to make sure that we have a cushion at closing and every step thereafter. We're going to expound upon that throughout the entirety of the episode here, but that's what it really means. It means having a margin of safety immediately at closing and then maintaining that margin of safety throughout the entirety of your journey on that individual investment and throughout the entirety of the portfolio. So let's go ahead and dig into how some folks have had shortcomings in this philosophy historically. You've heard the phrase that those who don't study the past are doomed to repeat it, and I couldn't agree more. Charlie Munger's got a really great, fascinating quote on this as well. He's an individual that always has this philosophy of invert, always invert. So when he's thinking about how can I create the best life possible for myself, as opposed to trying to craft what that looks like, he thinks, well, what would I need to do if I wanted to fail miserably at life? And he inverts that thought process. And some of the things that he's come up with really are striking and phenomenal. Do not be reliable. So if you're unreliable, you're definitely doomed to fail. But another one that I thought was absolutely exceptional, only learn from your lived experience. If all you're ever going to do is learn from your lived experience, then you're doomed to fail. Because there are so many individuals that have already walked the path that you have walked, that have already seen the same exact problems, because history repeats itself over and over and over. If we can avoid those same potholes and mistakes that history's greatest entrepreneurs and founders have inevitably overcome those those difficulties, then we're going to be much, much more well served as human beings, as investors, as business people, as fathers, husbands, brothers, etc. So we're trying to learn from all of the wisdom that's been shared throughout history to improve as human beings. But in this example, we'll share some of the mistakes that folks have encountered in their investing journeys and how we have modified our strategy to ensure that we can protect the downside risk and avoid some of the mistakes that they ran into along the way. One of the most cautionary tales in financial history is long-term capital management. This was a hedge fund that was run by Nobel Prize-winning economists and the best bond traders in the entire world. Okay, 16 different individuals, hundreds of years of combined experience, extraordinary intellect. Warren Buffett once said, this group of 16 individuals likely had a higher cumulative average IQ than any management company in the entire world, Microsoft included and a million other things. And he's such a huge fan of Bill Gates. So, I mean, he claiming that these individuals are literally have higher horsepower and intellect than anyone else in the world, and with hundreds of years of combined experience. By the 1990s, mid-90s, they had about $5 billion in capital that they were managing. But here's the problem. They borrowed over $125 billion. So they're at about 25 to 1 leverage. And their strategy was arbitrage. They were using modest price discrepancies in bond markets that were theoretically low risk. But they used massive leverage to juice the returns. Unfortunately, then Russia defaulted on its debt, global markets panicked, and suddenly positions that were once uncorrelated all moved against them all at the same time. So long-term capital management ended up losing $4.6 billion in 4 months. The Federal Reserve had to step in and organize a bailout to prevent systemic collapse. And Buffett was offered the opportunity to go ahead and buy the portfolio at a discount, but he decided to pass. And later he said, it is insane to risk what you have and what you need for something that you don't have and you don't need. Intelligence does not protect you from leverage. Models fail at exactly the wrong time. And leverage doesn't kill you in the good times. It kills you when liquidity disappears. Clearly, long-term capital management didn't do a comprehensive job of providing the best risk-adjusted returns in their strategy. The amount of risk that we're taking, obviously, was far too much for the incremental rewards that they were ultimately receiving. It's foolish to risk something that you have and need for something that you don't have and don't need. All the individuals that were running long-term capital management were successful individuals, but they were heavily invested in this venture. The vast majority of their individual net worths were all rolled up into this, and they ended up losing the vast majority of not only their reputation, but all their personal net worths for something that they really didn't need to risk. So again, the risk-adjusted return analysis was poor from their perspective. By way of example, Buffett used this phenomenal analogy to explain this exact situation, right? So let's say you hand him a revolver. There's 100 different chambers in the revolver, and you ask him to put the gun to his head. There's only one bullet in there, so the odds are obviously heavily in his favor that nothing is going to go wrong, as it were. But there's not a single dollar amount that Warren Buffett would be willing to accept for the risk to pull that trigger. I don't care if the odds are 100 to 1, 1,000 to 1, a million to 1. There's no time ever, doesn't matter what the sum is, that you would ask him to bet that it would be a successful investment, because the risk-adjusted returns are never going to be in your favor. Obviously, there's no dollar amount that would be worthwhile if he doesn't actually need the additional incremental increase in value there. And obviously, the downside, is pretty self-explanatory. From the risk-adjusted return perspective, a flawed logic from long-term capital management in this regard. And that's how you should be thinking about your investments as well. Making sure that you're protecting the downside risk. Never risk something that your family has and needs for something that your family does not have and does not need. Leverage is a chainsaw. You could obviously build something unbelievably beautiful with it, right? Chop down a tree and just build an unbelievably phenomenal mansion with it. Or you can cut off your leg. Long-term capital management didn't slip. They were running with a chainsaw down the highway at full speed, and they fell and chopped off their own legs. So leverage is brutal. It's a double-edged sword. And Buffett and Munger, they've been crystal clear about this for many, many, many decades. Of course, leverage can magnify your gains, but it also creates the one thing that you cannot recover from, which is forced liquidation. Buffett put it this way, like we talked about before: any series of positive numbers, however impressive, evaporates when multiplied by a single zero. And he also warned repeatedly about refinancing assumptions, because refinancing is not a plan. It can't be the material plan. When maturities come due, your loan maturity comes due, the only thing that actually works is cash. Buffett said that borrowers learn that credit is like oxygen. When it's abundant, it goes unnoticed. But when it's gone, that's all that is noticed. It's very much reminiscent of what's happened in the last handful of years here in the real estate industry, where obviously during the run-up, after COVID, interest rates unbelievably low, the lowest interest rate in 5,000 years, so inflated prices in an exorbitant manner. Folks continued to buy deals with higher and higher prices, lower cap rates, at ridiculous debt. The terms became more egregious. Folks started using floating rate debt with short-term balloons over the course of 2 or 3 years. And all of a sudden, what happened was, when the debt markets shifted materially in that window during the holding period, folks came to realize that whatever they assumed was going to be their exit and their refinance at year 3, when that debt came due, their refinance was no longer an option. That whatever de minimis margin of safety that they thought they had completely gotten wiped out, and they had no other options. And it is for this reason that so many folks have unfortunately had paused distributions, capital calls, and sometimes total loss of capital, because they have not thought through in advance the fact that markets change and they've not protected the downside prior to actually making the investment years prior. And I guess a part that people often miss is that Buffett doesn't avoid leverage because he's afraid or scared of leverage. He avoids leverage because he wants freedom. He wants freedom to sleep at night. He wants freedom to act when nobody else can. He wants freedom to play offense when everybody else is struggling to survive, when chaos ensues. If you're really being cautious throughout the entirety of your journey with respect to leverage, you penalize the returns ever so subtly by a minor amount, but you're granted the ability, both financially and emotionally, to play offense when everybody else is just struggling for survival. They're scrambling around just trying to survive. Then you can go on offense with significantly better terms, significantly more liquidity, and actually really generate much better outsized yields than what all of your competitors can at that respective time. So we just heard the best investor of all time's perspective on leverage. What about the best real estate investor's perspective on leverage and liquidity? How does Sam Zell feel about the same exact topic? Sam Zell, back in the heyday, learned the lesson the hard way. During one of the most brutal recessions, Sam Zell found himself massively constrained. At the time, his business was over $1 billion. And if you were to, use inflation to kind of make that into today's numbers, it'd be somewhere around $5-10 billion. Okay, so it was a real successful company, solid size and scale at that time. He was worth $1 billion. But at that time, recession hit, capital markets shut down, refinancing disappeared, and highly leveraged asset owners became trapped. Zell has told stories over and over again about scraping together quarters and dimes just to make payment. We're talking about a guy that's got $1 billion business and he couldn't even make payroll. He was struggling just to survive. He had to go to Pritzker and borrow $50 million just to try to make it through. He was in a precarious situation. And from that experience, he instituted a maxim that never went away. Liquidity equals value, not net operating income, not internal rate of return, not EBITDA, not hypothetical appreciation, cash, cold hard cash. Cash flow to ride out the next inevitable recession, and liquidity on the balance sheet to ensure your own survival. Because cash is oxygen. It allows you to survive when the world is just struggling to breathe. And it allows you to act when everyone else is cornered. And hearkening back to Charlie Munger's philosophy, if all we're ever going to do is benefit from our own individual lived experience, we're going to be a far cry beyond all of our competitors. It is from these bits of wisdom and these golden nuggets from the world's greatest entrepreneurs, the world's greatest businessmen, the world's greatest investors, that we've rolled together our Sunrise Capital strategy to avoid the same mistakes that the world's greatest investors have already made. The principle of protecting the downside is not theoretical for us. It's operational. It's something that's built into who we are and what we do. That margin of safety is a massive piece of how we operate over here at Sunrise. It's not all sunshine and rainbows. We're going to walk through some case study examples of how things have gone awry historically, but ensuring that you're protecting the downside risk can kind of get you through these situations. So we'll cover some of that in a little bit. But here's what protecting the downside means for us here at Sunrise. First and foremost, it means having a cushion at closing and then every step throughout the rest of the holding period. But one is buy with a margin of safety, right? Where the purchase price of your acquisition is lower than the current market value of that acquisition. That is the definition of buying with a margin of safety. Not hope, not optimism, a real gap between price and value. So we've got many, I can give you 40, 50 different examples and appraisals of deals where we've done this over time, but I'll give you a couple of different examples. One is a parking facility out in Charlotte, North Carolina. We did this deal a couple of years ago. It's called the Spectrum Garage in downtown Charlotte. Absolutely phenomenal location. Literally been in high demand for multiple hundreds of years. It is catty corner to the Spectrum Center where the Charlotte Hornets play. And this was a very complicated transaction. In order to make this deal work, we ended up getting the entire city block under contract. It was a $250 million total capitalized cost of the transaction. It came to us because we've become more well-known in parking. There's not a lot of guys out there doing what we do. It's a pretty niche real estate sector. And somebody ended up having a deal that was a mixed-use transaction. This entire city block had a hotel, multiple office buildings, as well as a parking facility. And so he was trying to find somebody that knew parking very well because a large chunk of income derived from parking. And so this deal hit our desk right after kind of, the downturn in COVID. So office values plummeted, office income dropped significantly. Folks weren't staying in hotels near as much. So the values of those assets dropped precipitously, but the parking was doing exceptionally well. People were still out there based on the multiple demand generators in the phenomenal location. The parking asset was still doing very well. But we don't consider ourselves specialists in all respective real estate sectors. We definitely don't fancy ourselves specialists in hotels, nor do we fancy ourselves specialists in office, most assuredly not office to residential conversions. But what we ended up deciding to do was going and getting a third-party appraisal, looking at the parking exclusively as parking in and of itself. If we remove that parcel of land and we only bought the parking, that's all we cared about, how much would that be worth? And the appraisal came back that it would be worth $35 million. We said, great, we'll pay 31. And then we went and found others that specialized in the other areas of business that we didn't want. We didn't want a hotel, so we found a hotel operator. We didn't want the office building, so we found somebody who was exceptional at doing office to residential conversions. And they took those assets off our plate. We went and bought a parking asset that was valued at $35 million immediately out of the gate, and we purchased it for $31 million. That's a $4 million margin of safety, beautiful, right out of the gate. And that's what we mean when we say we buy with a cushion at closing. Another deal where we can exemplify the idea and the concept of P, protect the downside, is a small little mobile home park we ended up buying. This is literally the very first mobile home park that we ever did. It's in Georgia. It was a 29-space mobile home park, literally bought from the bank for a mere $200,000. At the time, literally had no income. In that mobile home park, 29 spaces were 29 individual empty shells. And what we knew going into that respective transaction was, what is the worst case scenario? Very much like the old Benjamin Graham philosophy of cigar butt investing. The individual assets that we were buying, the tangible assets, were worth more than the cumulative purchase price. Even if we didn't do any sort of high quality value add strategy to get residents in, to get tenants paying on a monthly basis, if all we ever were able to do was to take the individual mobile homes and literally sell them off, that would have been worth $290,000. You literally couldn't go wrong in that respective deal. You could not lose money. This is the definition of Benjamin Graham's cigar butt investing. And that was how we got started in this respective business. That's the definition of buying with the margin of safety, right? That is an example of it. But it's a short-term version. And that worked for Warren Buffett in his earliest ventures. He was able to start buying some cigar butt businesses, but then eventually began to realize that it's more prudent to buy wonderful businesses at a fair price than simply buying mediocre businesses at a deeply discounted price. And over time, we've evolved away from trying to just buy everything ridiculously phenomenal off-market, direct to owner at a discounted price, but rather pay wonderful businesses, deals that literally have exceptionally profound long-term macroeconomic tailwinds, truly phenomenal assets that we know are going to be in high demand for literally generations to come, as opposed to some assets that may not have that sustainable cash flow over time. There's a distinct difference there. But this was a perfect example of literally protecting the downside risk. If we're literally buying it and there's no way we could lose money, worst case scenario is we just got to sell the individual shells and it'd be worth more than the cumulative purchase price, the entire mobile home park. That's a perfect example of protecting the downside. We can give you numerous examples of this. We've got another, mobile home park that we bought in Ohio that was not too dissimilar. We ended up buying it for $13.5 million, appraised just north of $15.2 million, something like that. But the point is a little bit more than a $1.5 million margin of safety immediately at acquisition. But when you take into account the additional leverage that we used at closing, we ended up having roughly a 28% return on equity immediately at closing on that respective investment. That's what we mean when we say buy with a margin of safety, right at acquisition, right out of the gate. You're not buying on hope. You're not buying on optimism. You're buying with a real gap between price and value. Across our most recent fund, Fund 4, we just closed it out. We ended up buying $197 million of real estate, but the cumulative appraised value immediately at closing, all those assets, was $222 million. Again, a $25 million margin of safety between the purchase price and the appraised value immediately at acquisition. So that's downside protection before we ever think about the upside. And that's what we mean. Invert, always invert. When folks go into investments, they're always thinking about how much money can I make, this, that, and the other. Charlie Munger would say, invert, always invert. What we're thinking about is not how much money can I make, but rather, how can I lose all of my money? And we squash every single one of the ways that we could lose all of our money to the best of our degree. And assuming we've squashed all those, then we'll contemplate going ahead and acquiring that deal and implementing the business model and generating the best return on investment that we can. But we're first focused on return of investment before we ever even contemplate return on investment. But protecting the downside does not only mean buying with a margin of safety. There's several different additional things that we'll layer in. I got a handful more that we're going to walk through here in terms of what we mean when we say protecting the downside risk over at Sunrise before we dig into some actual case studies and examples of how this has played out in real time. But the second piece of the puzzle in terms of protecting the downside risk is applying modest leverage, conservative debt. And for us, this means on any given individual deal, we might have an LTV that goes up to 60, 65, maybe on the high side, 70% LTV. But on the fund as an entirety, right, across the numerous different assets inside of the fund, we like to maximize our LTV at 60%. We feel like that's very conservative, and it allows us to absorb any of the shocks that would inevitably occur. You never know when the next black swan event's going to occur, but we want to make sure that we've got a nice margin of safety and we're not over leveraged to the gills. What about on the low end? We like to have our LTVs range in the fund somewhere between 40% on the low end and 60% on the high end. When the loan to value drops down to 55 to 50 to 45, down to 40%, right? Because when we buy assets with a 60% LTV, over time, assuming we're implementing the business plan well, revenues are increasing, expenses are decreasing, our NOIs are going up over time, the value of the property increases, our LTV drops from 60 to 55 to 40 over time. The LTV is so low that it is adversely affecting your return on equity. And whatever modest incremental additional leverage we would use would be accretive, and it wouldn't add that much risk to the table. Again, if we're only going to max it out at about 60%, we're then comfortable bringing the LTV up from 40% on the floor to about 60% on the high side. And this is the comfort zone from our perspective, where we know we're not getting out in front of our skis from a debt perspective. Another way that we like to share that we've got conservative debt is we like to use fixed rate debt, period, end of story, because we know what we're signing on the dotted line, because we never know what the future holds. My crystal ball is broken. Your crystal ball is broken. The Fed doesn't even know what they're doing. Our willingness to sign on floating rate debt is negligible. We don't do that because we know that the next black swan event could be tomorrow. I mean, today could be a version of September 10th, 2001. You never know when that next inevitable crazy black swan event is going to occur that just completely shocks the interest rates and could lead you to ruin. So we're just unwilling to do that. We also never want to be in a situation where we're praying at refinance that we can just maintain and hold the asset and we don't have to liquidate. So you want to have long-term fixed rate debt to the best of your ability. And the shorter the term debt expiration, the more equity you need to have in that respective investment. Because if you're over leveraged and you have very short-term remaining tenure on that respective debt, that's when you can get into an exceptionally precarious situation. Which leads me into the next step in the process in terms of staggering term debt expirations. We obviously prefer to use fund structures as opposed to individual deal-specific syndications because we feel like it minimizes risk from the perspective of everybody involved. I've already made the point that nobody knows when the next inevitable black swan event will occur. So it is for this reason that it's much better to stagger your term debt expirations across many different dates, many different periods of time, many different years, as opposed to having all of those term debt expirations come due in one moment. Because if all of your debt comes due in one moment in time, and it just happens to be the next version of the savings and loan crisis, or the Great Recession, or COVID debacle, or the interest rate increases, you could be in an exceptionally precarious situation. And we don't want to find ourselves in a spot where we don't control our own destiny. So we stagger those term debt expirations to minimize the risk on the portfolio as a whole. It's why, yet another reason, a fund structure is much superior, in our humble opinion, to deal-specific syndications, because you can never remove that timing of term debt expiration as a risk from an individual deal-specific syndication. It's why, again, we've been fortunate to have no capital calls, no paused distributions, no loss of capital over time when we've seen so many different sponsors, unfortunately, have those events occur. Another thing that we love to really ensure that we have is sufficient cash. Speaking about cash in general, not only cash flow to ride out the next inevitable recession, but also liquidity on the balance sheet. We can obviously go learn the hard way, or we can just read the biographies of Warren Buffett and Charlie Munger and Sam Zell and learn that Sam Zell, the best real estate investor of all time, learned this 30 years ago when he almost went bankrupt because he couldn't make payroll because he didn't have enough liquidity on the balance sheet. Now that we know that, I'd rather just go ahead and learn from his mistakes over time as opposed to us having to feel them personally. So we'll make sure that we have sufficient amount of cash on the balance sheet so that if and when that next inevitable black swan event occurs, we'll be able to ride it out and be able to survive until greener pastures arise. And the last topic we'll discuss in terms of mitigating the downside risk and protecting the downside in terms of our strategy is having multiple exit strategies. You never want to be in a situation where you've underwritten a deal and you have to have one specific outcome occur, or else your deal goes to zero and you lose all of your money. Because then you're in a hostage situation. That's not a strategy, right? That's a hostage situation where you're too heavily dependent on something outside of your control because your crystal ball is broken, my crystal ball is broken. You can't predict the future, so you have to have optionality. And what that means is you need to be able to, should you choose to do so, and market conditions warrant, hold for cash flow. One option, hold on to it forever. Just hold for cash flow. Another option, sell it. Sell it to a different buyer, somebody who's willing to pay a premium over and above the intrinsic value of the asset. And the third one, refinance without crazy heroics. Refinance because market conditions warrant. Maybe the interest rate environment went down suddenly. You've got great cap rates. You can extract the vast majority of the equity that you invested. Life is good, but maintain a solid margin of safety, maintain sufficient DSCR, maintain sufficient cash flow so you don't put yourself in a precarious situation. Again, right? So it's not only having an appropriate amount of debt immediately at acquisition, but throughout the entirety of the holding period. But you have to have that optionality when you're going into a respective real estate investment. You can't just say, I'm going to buy, fix, and sell it in a 2-year stint, or buy, fix, and sell it in 3 years. Because if you do, you could end up holding the bag if the market shifts underneath your feet in a very short period of time. That's how you have capital calls and ultimately total loss of capital inside of transactions. You need to have optionality so that you could ride out the next inevitable recession and make it to the other side so that you can have material liquidity events when market conditions warrant, as opposed to having forced liquidity events, because that's when imprudent decisions are made and people lose money. As I promised earlier, guys, I wanted to talk about our failure case, right? Like a case story where it's not all sunshine and rainbows, right? Not every single deal we do is a single, double, triple, home run, grand slam. It's also important to learn. You learn way more from the deals that didn't work out than the deals that actually do, right? So let's dig into one of those respective transactions here today. And I would say here's a truth that most sponsors won't admit. The only thing that I can guarantee when I send you a pro forma is I guarantee you it's going to be wrong. It's either going to be better or it's going to be worse, but I can promise you it is not going to be accurate. It's just because there's so many different assumptions that have to be made on an Excel spreadsheet over the course of the next 10 years when nobody knows what's actually going to occur. It's impossible. So you try to mitigate downside risk to the best of your ability. But we had a mobile home park in Oklahoma that's Stillwater that did not perform anywhere near the way that we would have otherwise expected. We did everything that we possibly could in advance to mitigate the downside risk, but it didn't go as planned. Cash flow was much weaker than we anticipated. The deal was a headache, and I guess that's putting it nicely. You know, there's an 80-20 rule where typically 20% of the deals take up 80% of your time, and this was a perfect example. It probably took up 95% of our time given the amount of angst that it was placing inside of the organization. And the business plan just didn't play out the way that we would have otherwise anticipated. But because we spent so much time in advance protecting the downside risk, we used conservative leverage, we bought with a margin of safety, we had significant liquidity, we didn't lose capital. And at the end of the rainbow, we ultimately sold the asset for slightly more than we paid. It's not a home run, but it was survival. And we were able to move on to the next deal, and survival preserves capital and preserves the compounding. So we could ride off into the next deal and continue that compounding in another asset that has a much better long-term macroeconomic outlook than that individual transaction did. So again, tying it back to the pro forma, you know, the only thing that I can guarantee you is the pro forma is going to be wrong. And in this case, obviously it was once again. I think Charlie Munger, you know, explains this pretty well. The way that he thinks about businesses is he thinks about it like a bridge. He thinks about businesses like bridges, engineered systems, redundancies, stress tested for extreme conditions. He's literally said before, it is illegal to imprudently engineer bridges in this country. And he feels like it should be illegal to imprudently engineer businesses in the same vein. So Sam Zell said it perfectly. Redundancies are much more predictable than theoretical opportunities to add value. So for us, when we're looking at the pro forma, you've got to find, there's a million assumptions that go into it, but you've got to ensure that you build numerous redundancies into the pro forma to mitigate the downside risk to the best of your ability. Protecting the downside, it's not pessimism, it's architecture. You're engineering the deal. It's building something that can withstand all the storms that you can't predict. So what went wrong in this deal? One of the giant crazy misnomers in the mobile home park sector, just the name mobile home is known as a misnomer. Mobile homes typically only move twice. First, they move from the manufacturer to the mobile home park, and then they move from the mobile home park to the dump after the end of the home's useful life expectancy. They usually stay in the community for literally decades and decades and decades, sometimes multiple generations, because it's cost prohibitive to move a mobile home. Why is this the case? Well, you know, it takes maybe $8,000 to move a single wide. It's going to take 5 figures, $12,000 to move a double wide. And every time that you put it on a new chassis and move it down the highway, it's going to adversely affect the interior. There's going to be more costs associated with it. The only logical, reason folks would move one mobile home park to another is oftentimes because they're going to end up having a lower monthly cost at the other respective community. Let's say your community rents for $300 a month, and the community down the road is renting for $275, okay, some version therein. Well, that's $25 a month that they're ultimately saving. Think about the break even, the payback period necessary to ultimately justify spending $10,000 in an outbound expense when you're only saving $25 per month in rent, recapturing that on a monthly basis. And there's no guarantee that the guy down the street is not going to increase his rents to $325 the minute that you get there. It's for this reason that mobile homes typically never leave the community once they ultimately arrive inside of that respective mobile home park. That had been our experience historically, and it has been our experience in every single mobile home park that we've owned, except for this one. It was a very unique and odd scenario. We had numerous homes that were ultimately leaving the community. There was a situation where a mobile home park in the vicinity ended up having lots that ended up getting sold individually. It meant that the individual residents inside of our community, for just a few $1,000s, were able to kind of buy their own individual parcel of land and move their home out there. So the break-even period was close enough to where they knew that eventually the lot rent was going to go away in its entirety. And they could see the writing on the wall that if I stayed here for a long enough period of time on that small parcel of land, that it would end up being a reasonable break even from their perspective. It was just this ongoing churn. We were working our fingers to the bone just to stay above water. And what I would use is the analogy of a tub. Inside of a tub, if the real estate investment is a tub, and my goal is to try to increase NOI, i.e. increase the volume of water inside of the tub, there's two things that I really need to do. First thing is I need to make sure that the faucet is on. I've got a lot of water coming into the tub. And the second thing that I need to do is make sure that the drain is clogged. That we've actually capped the drain and you're not losing money out of the bottom. And in this example, we were bringing in homes left and right, selling a lot of homes, bringing in new residents, doing an exceptionally high quality job. There's a massive demand for affordable housing, massive demand for our product. We're moving a lot of units, etc. But unfortunately, on the back end, we're seeing homes get pulled out left and right, and we're losing a lot of revenue and a lot of residents along the way. So we were constantly churning cash, constantly churning capital, and we were not able to make any material ground in terms of formally adding value in the material sense. Certainly the way that we would have otherwise anticipated and the way that we had underwritten inside of the pro forma. If we had not protected the downside risk in advance, if we had not bought with a margin of safety, if we had not intentionally had massive amounts of sufficient reserves on the sideline in advance of closing that property, if we hadn't done those things, we would have likely run out of money and had to do a capital call, or we would have likely ended up having a DSCR issue where the bank would have come calling to take that asset back because the revenue getting generated wasn't high enough. We could have had an occupancy issue where the bank could have called the note due. If we had over-leveraged the asset too much, all of these, what seemed to be modest, inconsequential decisions on the front end, any individual one of them could end up having the deal blow up. But if you squash all of those individual problems in advance of closing that transaction, we were able to at least salvage the deal, albeit have a very modest cash-on-cash return and a very modest outcome. I'll call it a single, as opposed to a double, a triple, a home run, a grand slam. We were able to maintain all of the original base of capital and keep the capital compounding over long periods of time. And that is better than a sharp stick in the eye, in my humble opinion. Protecting the downside risk is paramount to ensure that you never stop the compounding. How we manage capital over here at Sunrise, it's how we try to manage our own family's capital for the betterment of everybody involved. Here's the big idea to take with you. Survival precedes success. Protecting the downside is what allows compounding to actually work. It's what gives you the right, not the obligation, to play offense when everybody else can't. You don't need to get rich twice. Most investors, they don't need more upside. They need fewer mistakes. You just need to avoid complete and utter ruin where you lose all your money. So protect the downside and let time do the rest. Next week, we're going to flow into the fourth part of our 7-part series where we're going to go into letter I, which is invest, don't speculate. We're going to talk about how compound interest over a long period of time is truly the eighth wonder of the world and why so many folks believe that they're investing when they're actually speculating. So until next time, you be great.